Good morning everyone, I'm Ken, Financial Analyst from Regain Capital, and welcome to our morning market briefing on the 4th of November, Wednesday. So, as usual in our market briefing, we will cover three parts, namely the fundamentals, the news release, and the technical analysis. So without further ado, let's start off with the fundamentals. When we take a look at yesterday's market movement, we can see gold extending gains by 0.74%, the euro climbed higher against the dollar as much as 0.68%, the dollar index fell by 0.66%, and oil higher by 2.85%. So let's get into further details with the headlines of today. First off, we have the gold, where we can see the gold rallied above the 1900 levels and extended gains for the third consecutive days amid US election uncertainties. Now, the polls initially signaled a Biden lead, however, latest readings now show a tightening gap between both sides. Investors are parking their investment into the gold market, with many expecting a large-scale stimulus package ahead that would prompt gold prices no matter the election outcome. So instruments involved here would be gold itself. Next, in correlation, let's talk about the dollar, where we can see the few major challenges faced by the dollar index. First off would be the election, next would be the FOMC meeting and the non-farm payrolls jobs report. So the dollar index plunged overall on Tuesday as America votes for their 46th president, where both candidates are still in a tight race as of writing. However, investors are already pricing in a weaker dollar ahead of a large-scale stimulus regardless of the election result. Now, on the other hand, the dollar index movement as we speak will also be influenced by the upcoming FOMC policy meeting on Thursday and the US monthly job reports, namely the non-farm payrolls on Friday. So we can see that now currently market movement is shifting away from the safe haven dollar into the gold, as expectations for a large global large stimulus and a large money supply of the dollar would trigger a demand for the gold and the sell-off for the dollar index. So we will wait for the election results and to see further movement ahead. And instruments involved here will be dollar index itself and major currency pairing against the dollar as well. Moving on, let's take a look at the news release for today. So please take note, times stated here are at GMT plus 8. So the first data would be at 9:15 from the US, which is the mini NFP or the ADP non-farm employment change. So as investors are waiting for the results of the election, the ADP data would be slightly ignored by the market. However, it will still bring some impact towards the dollar movement as well. So the data is forecasted to create less jobs compared to the previous month of 749,000, where economists are now expecting only 650,000 jobs created for the non-farm sector. And at 11 would be the ISM non-manufacturing PMI, expected to fall lower from previous month of 57.8 to 57.5. So overall, both data are expected to be lower than the previous month, and any reading below the forecasted value would actually exert negative pressure onto the dollar. At 11 PM will also be the crude oil inventories report by the Energy Information Administration, where is expected overall inventory to fall from last week of 4.3 million to only 0.8 million build-up. So any reading higher than the forecasted value would actually indicate a higher supply or inventory levels for the oil, and that would exert negative pressure onto the oil prices. So that's all for the news release. Moving on would be our technical analysis. So here's an overview of instruments to be covered. First off, Euro, Canadian dollar in the H4 chart showing a downtrend. Australian dollar against New Zealand dollar, H4 chart showing an uptrend. For the GBP JPY, H4 chart also in an uptrend. And for gold in its daily chart, also still in a bullish trend. So as you can see that the instruments today would be more towards a cross pair, as we are still uncertain towards the election results, and any US major pairs would experience large fluctuations following the results. Thus, moving on, let's take a look at the chart analysis, starting with the Euro Canadian dollar. So in this H4 chart, before that, let's take a look at daily chart. We can see that the pair is trading on the close to its 200 moving average, which is also a strong support near 1.5390. So in this H4 chart, we're constructing the Fibonacci from the highest level here towards the lowest point, and we have obtained the psychological resistance and support for the pair. In terms of MACD, although signaling a diminishing bearish momentum, however, we would wait for a breakout from either side, whether it's the 23.6 near 1.5450 or below the 0.0 Fibonacci near 1.5360 before entering into positions for the Euro Canadian dollar. However, for aggressive investors, following the signal from the MACD showing a diminishing bearish momentum, aggressive investors can consider long positions at the current level 1.5390. Stop loss should be placed below the 0.0 Fibonacci at 1.5360, and a take profit can be targeted all the way to its 23.6 Fibonacci at 1.5450. However, for cautious investors, as speak, please wait for breakout confirmation from either side before entering into the market. Next, for the Australian dollar against the New Zealand dollar, now constructing the Fibonacci from the previous high towards the low, you can see that the pair is now currently trading back lower, testing its 23.6 Fibonacci near 1.0670. Now previously we have covered for a strong positive divergence for the pair, and the pair has actually succeeded in breaking both its 20 moving average and the 60 moving average to above the 23.6 Fibonacci. However, as it retests back towards the level, cautious investors are advised to wait for the next H4 candle to see whether the pair will be closing above the 23.6 or below the 23.6 Fibonacci. Now waiting for the next H4 candle would trigger either side, whether it's a long order or a sell order, where closing below 23.6 would signal further downtrend for the pair, and investors can consider entering into short positions thereafter, whereas for the closing above the 23.6 would signal the end of its bearish momentum and to extend further in a medium long-term trend. So cautious investors are advised to consider long positions after a closing above the 23.6 Fibonacci at 1.0670. Next, for the pair of GBP/JPY in the stage 4 chart, now constructing the Fibonacci from the previous high towards the low, we can see that the pair was able to rebound off its low levels and attempted to break above the 38.2 Fibonacci, however fell lower thereafter following the uncertainties of the election results. So cautious investors here are advised to wait for a breakout confirmation, whether it is from the 38.2 Fibonacci near 136.9 or below the 23.6 Fibonacci near 135.5 before entering into positions for the pair. Now aggressive investors are advised to consider long positions following the end of its downtrend expected here, and following the MACD signal of a bullish momentum as well. So aggressive investors can consider long positions near 136.2. Stop loss should be placed below the 23.6 Fibonacci at 135.5, and the take profit targeted all the way towards the 38.2 Fibonacci at 136.9. Lastly, for gold in this daily chart, now we can see that gold is currently trading in a downward channel and is currently testing towards the top level of the downward channel. So overall, investors should wait for a breakout confirmation before entering into the gold market. MACD signaling a bullish momentum, so we will wait for a breakout from the downward channel before entering into long positions for the pair, where the upward resistance should be somewhere placed around 1920. And cautious investors are advised to consider long positions after the breakout above 1920. Stop loss should be placed 100 pips from the level and at 1910, and a take profit targeted all the way towards the next resistance around here at 1970, or to be even shorter, 1940 would be a risk stop loss and take profit ratio of 1 to 2. And if the gold fails to break above I might continue its movement within the downward channel, and investors are then advised to consider short positions with a stop loss around 100 pips and a take profit around 200 pips. So that is all for our market briefing. Please remember to follow us on our social media such as Facebook, Telegram, Twitter, as well as Instagram, and feel free to drop by our website at www.regaincapital.com to get updated on all the latest market news as well as education posts for our clients. So thank you all for listening. We'll see you next time on our market briefing, and happy trading to all.